and welcome to our class on easy as 1, 2, 3 trading with Japanese candlesticks. Today's class is brought to us by LegacyFX, one of the world's leading Forex and CFD providers. Now, Legacy is a regulated provider. They offer you 4 dynamic platforms, and you can choose from one of them or all of them. You can use their web trader, their mobile trader, their MetaTrader 4 you can download for a professional environment, or you can use their Xeric Station for the up-to-the-minute trading platform with a wide range of advanced tools. You choose one, all of them, however you want to trade. As you can see on the screen, their platform is dynamic and user-friendly, easy on the eyes, and you can adjust everything to what fits you. You can customize your exact view. Now, at Legacy, the philosophy is simple. Offer focused and personalized service that makes trading logical. LegacyFX cuts through the excessive jargon and provides financial content in a large and language that is comprehensive to all of us. They also want to help you succeed by letting them educate you, and they offer for that a wide array of education materials. They also have many choices when it comes to deposit and withdrawal methods. They offer their LegacyFX Pro Rewards program. They advance security so that you're trading your personal data and your funds are always safe and secure. And they offer their trading academy that has something for everyone, whether you're a novice, a beginner, a professional, or an experienced trader. Now, since Legacy is a regulated provider, I'm therefore required to give you a risk warning. So let me read the first paragraph, and I'd appreciate if you could read everything else that's on your screen. Spread bets and CFDs are complex instruments and come with a high risk of losing your money rapidly due to leverage. 76% of retail investors' accounts lose money when spread betting or trading CFDs with Legacy. You should consider whether you understand how spread bets or CFDs work and whether you can afford to take the high risk of losing your money. Now, today's class is being recorded. If you wish to see a recorded version of today's class, you can do so in about 24 hours by using the same link used to attend today's class. Or when investing.com has had time to edit and clean it up, you'll be able to find it on the investing.com website under the Education tab, and then look for webinars on demand. And in fact, there you can see all the webinars we've ever presented over the last 7 years and watch them at your leisure. Now, in today's class, I'm going to use the term security, but I might also, and I know I'm going to say the euro, I might say Bitcoin, I might say Facebook, I might say Google, but I'm not referring to any particular asset. I'm referring to all publicly traded financial instruments in which an open market exists. Similarly, I intermix the terms investing and trading. Typically, an investor takes a long-term position while a trader takes a much shorter-term position. We know the difference, but it gets very boring just saying trading, 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 trading. So I mix up the terms to make my presentation a little bit more interesting. Now, before I go on, let me mention, if you look on your screen, you can see 2 handouts. One is the Candlestick cheat sheet, and this goes over all the different patterns that one would look for in candlesticks, from single patterns to double to triples, and explain to you what you should do when you see them. But we'll come back to candlestick patterns in a second. I've also given you the technical analysis guide from investing.com. This is an excellent resource guide. Download it, keep it, use it when you want. Both of these downloads are free. They're just click on your button. There's no registration. There's no anything. They'll be put on your computer. You can use them at your leisure. Now, most new traders learn a little bit about candlestick analysis. Candlestick analysis is what that cheat sheet that I gave you is based on. But most of what they learn is completely useless. Why? Well, the standard approach to candlestick analysis is basic pattern recognition. Hence, again, that cheat sheet. But it fails to work in real trading, especially quick moving online trading. Now, you can't skip straight to advanced candlestick analysis without knowing some of the basics. But don't worry, I've got you covered. And again, that's why I gave you that cheat sheet. Now, when Forex traders first start out, they usually learn about candlesticks, but what they usually learn is useless. They normally see a list of candlestick patterns like the ones on the cheat sheet. Each pattern has a set in stone definition, and that is the only meaning it can have. We have hammers, inverted hammers, dragonfly dojis. We have spinning tops. We have hammurabis. We have marabuzus. We have gravestones. We have spinning tops, shooting stars. Just goes on and on and on. But this, in fact, is not candlestick analysis. It is pattern recognition. And for a price action trader, it's basically useless. Actually, it's worse than useless. Thinking about candlesticks as just as patterns is counterproductive. It makes you a worse trader and it leads you to make massive mistakes. Why? Given a pattern, a set definition leads you to tunnel vision. So maybe you want to take that cheat sheet and tear it up now. When you see that specific pattern, you assume that something will happen. But to be honest with you, that's not really how candlesticks work. All candlesticks need to be assessed based on the candlesticks around them and many other factors. Now, normally people say that a spinning top means a reversal is imminent, which can be true. However, the same pattern can also mean that a continuation is imminent. It can mean that price is just temporarily stalling. It can mean a lot of different things. So thinking of candlesticks as simple patterns is the wrong way to do things. You need to look behind the pattern and read the story of price. Okay, and what's the story of price? Well, every single candle on your chart is telling you a story. When you combine those candles together, you get the story of price. So don't worry about memorizing all of these weird names and what they're supposed to be and how they're supposed to be described, and then what you're supposed to do. Learn to read price action with candlesticks. So the foundation for my trading strategy is reading and understanding the story of price. Reading and understanding the story of price is vital. It is vital because it allows you to answer one of the most important questions in trading. What is that? Who is in control of price and the markets? The question has three possible answers: buyers, sellers, or neither. And most of the time you're going to find it's neither. Price tends to just bounce around. So being able to accurately answer this question is vital. If you're about to enter a short trade, you need to ask yourself, who is in control of price? And your answer, if you consider, remember, if you're considering entering a short sale, and if your answer is buyers, well, perhaps selling isn't such a great idea. So let's break down the story of price. If you look at the three highlighted candles, it's easy to conclude that the sellers are in control of price. That is your natural assumption when you see massive red candles, price moving down. And what do you say? Oh, the sellers are the boss. The sellers are dominating the markets. Well, the candles all closed lower than they opened. They all created new lows beyond the previous candle low, and they all had small upper wicks in comparison to the candle body. The small upper wicks indicate that the buyers were unable to push price up much. But what does the highlighted candle you're looking at right now tell us? It has a short upper wick, a small body, and a long lower wick. This is an indecision candle. Now, don't get yourself so excited. Okay. We get indecision candles all the time. It could mean the buyers or the sellers are just tired for a minute. It means they can sit on the sideline. Maybe it means they're looking at the news and whatever Donald Trump has to say at the moment, and they all stop trading for a minute. Whatever. Indecision candles appear quite often. Okay. But you have to be able to see them, but you don't want to do anything about them. So what's an indecision candle? Indecision candles occur when neither the buyers or the sellers can gain them and maintain control of price. They are common, but if used in the right way, they can be very, very powerful. So we're going to take a look at the bullish trend on the next page, and we can see the strong trend. And then what do we see? Okay. We would say that we have the bulls in control. They're pushing the market. And then we get an indecision candle. Does that really tell us anything? Nada, nothing, nope. But if we add a little bit more to it, it might. When price hits resistance, we get an indecision candle forming. So let's break this candle down into a story so you can understand why it indicates indecision. First of all, the candle has a large upper wick, and it shows that the buyers tried to continue the bullish trend but failed. Sellers took control of price and pushed it down. Okay, so we saw the bulls did make headway this period. We formed a new high, but they couldn't hold on to it, and the sellers took control. But I added a little bit of something into that statement. Oops. I said when it hit resistance. So the small bearish body shows that sellers were able to close lower than the open. This is significant because in the last three candles before, the price consistently closed higher than open. This shows us that the buyers may be losing power. We also have a small lower wick. That means that the price closed near the low. But again, I said that little secret word. It was on or at a resistance zone. So altogether, this indecision candle forming right after a strong bullish move suggests that the power has shifted from the decidedly bullish or buyer market to an undecided market. Not that it's going to go down, not that it's going to continue up. It's undecided. While sellers are not in control, neither are the buyers. But there's one more thing that we have to look at. The indecision is forming on top of a resistance area. Okay. So if we have properly designated and drawn on our charts our support and resistance areas, and if you stop to think that resistance is not a definitive number. Too many traders draw lines on their chart and they say 106,472 is resistance level. It isn't, because resistance is not a finite number. We might say 1046 to 10467 is definite, is decision, because it doesn't, price doesn't actually stop right on that price. But if it stops 10 pips above it, that's still close enough to that resistance line. So we think of these, if we think of them properly, we think of them as zones. So if you're properly set up your charts, you will have your support and resistance zones drawn on your charts already. Because no matter how you're trading, you should know. So if you remember, we talked about resistance being a sell area, support being a buy area. So the image above shows us three strong bullish candles heading into an area of resistance, and then bam, price stalls and we get indecision forming on top of that area. This tells us that the selling area is working, because each level of resistance or support or reverse when the price is coming down is an area where price should or most likely will stop or at least hem and haw. Okay. When we see that it actually did, and so we're only talking about when an indecision candle appears in that resistance zone, not when it appears below it throughout the trading. I mean, because you get a zillion of them. It's only when it appears on that zone that it becomes important to us. And this tells us that the selling area is working. When price pushed into that area, sell orders were triggered. Okay. The sellers weren't people sitting around all day and waiting for that price to hit. When they set up their buy and sell orders, when they set up their limit orders, when they set up their take profit, most people use those based on resistance to support zones. And what happened was when price reached that point, it triggered lots of sell offers. Okay. And this story gives us a nice little price action trade setup. The price action allows you to take many different types of trades: reversals, continuations, range, swing, breaks, scalps, to name a few. So how do you spot a reversal trade? Well, reversals occur quite often, but if you do not know what to look for, you cannot trade them. Reversals are one of the strongest price action setups and one of the easiest to trade because they occur so often. You can trade this setup exclusively and be a profitable trader. So reversal trades come in three parts. The preceding trend. Now, when we say trend, we're not talking about a trend line. A trend is just a movement. A trend could be just the last, ultimately, 3 candles price movement. Okay. And then we get the reversal trend. So the preceding trend is a strong move by either the bears or the bulls heading into that area of support or resistance. So here you can see a strong move downward. The bulls have come into the market and they're pushing down. And here we see just the opposite. The preceding trend in the first case was a very strong bearish move, indicating there was lots of bears in the marketplace and very few bulls. If the bulls were to stop, then price would not be trending down, as you can see here. The preceding trend shows us that the bears have strong control of price and they are pushing price down into that support area. Okay. The opposite applies to the bullish preceding trend, which would show bulls, which is right here, trending towards resistance, as you see. Now, a preceding trend can be formed by as little as 1 candle. If the candle is strong and covers a lot of price distance, I categorize it as a preceding trend for the purpose of reversal trading. Okay. Now, this is a very sticky matter. Okay. You got to be very careful if it's a one massive candle. Okay. But one massive candle can set you up for a trade opportunity, because if we get that indecision right on that resistance area, support area, price will most likely bounce back up and go back to where it was. So preceding trends are simple. If you see a strong move heading into an area of support or resistance, you can consider it a preceding trend. Then we need the indecision candle, because regardless of whether you define it, if we don't get the indecision candle in the support or resistance area, you got no setup. A reversal setup will have 1 to 3 indecision candles, and the indecision candle needs to form on or near to the support or the resistance area. Now remember, this candle, an indecision candle, it doesn't need to be the opposite color, but it needs to be an indecision candle with a small body where the bulls pushed their way up but weren't able to sustain. So it didn't close anywhere near the high. Because when price is moving up, it should always close close to the high. The indecision is the width of the candle. Small body candle means the market has indecision. If the indecision candle does not form on or near the area of resistance or support, it's not a valid setup, just like you see here. Okay. We get them all over the place all of the time. Why does it need to be on an area of support or resistance? With indecision candles in a bullish preceding trend indicates that the buyers are possibly losing control and the sellers may be gaining control, but there's no proof of this. Okay. So you're setting something up based on speculation and the odds being in your favor. In a bearish preceding trend, It indicates that the sellers are losing control and the buyers may be gaining control. However, an indecision candle does not indicate that price will reverse with any degree of certainty. Nope. An indecision candle indicates only one thing. Guess what? Indecision. Okay. You cannot take a trade based solely on indecision. Okay. The image here shows indecision forming many times, having nothing to do with the support and resistance area. If you were to enter a reversal trade based solely on indecision, it wouldn't work out too well. So what about when a bullish preceding trend heads into an area of resistance or a bearish into an area of support? Well, then we get the makings of a high probability reversal setup. But we cannot enter just yet either. We need confirmation, which comes in a part 3 of the reversal setup. And that's the reversal trend. The reversal trend is the third and the most important part of the reversal setup. This is where we make our profit. After a preceding trend stalls at support and indecision forms, you often see a reversal trend. The image behind it, my text, shows a bearish reversal trend forming after indecision. So we can see indecision moving up. We can see trend moving up, indecision candle, and then we have our reversal. Now, like I said, even when we had that long candle, price just reversed down to where it was, back down to its lower support. But that gave us a nice trade. But how do we get that trade? Let me just clean up the screen here. In this case, we saw a transition of power from the bull's preceding trend to the bearish reversal trend separated by a stall on resistance. But where do we enter that trade though? You know what a reversal trade looks like. You know that you need to enter after indecision, but you need to enter before the reversal trend. Because otherwise, if you wait for the reversal trend, by the time you enter, you've eaten up most of your profit. So I'll show you exactly how to use my strategy. Entering does not need to be difficult. Remember, my goal is to keep everything simple, getting it at the right time. So as I explained, the reversal comes in 3 parts: the preceding trend, the indecision candle, and the reversal trend. You need to enter the reversal trade after part 2, the indecision candle, closes, but before part 3 completely takes off. Obviously, you enter after the reversal trend takes off, it's too late. You also need to make sure you do not enter too early, as you could be entered into a false setup. So this could happen no problem at all and happens quite often. Price, indecision candle, but then the bears continue to dominate. If you would have traded a buy to recover to here, you would have lost your money. So how do we have this not happen? How do we trigger our trade? Well, failed trades happen. There's nothing you can do about them. But getting in at the right time lowers your percentage of failed trades. Many people wait for a candle close to get in. But I have tested this early and waited for closes, get you in way too late. So in the image I'll show you in a second, you can see the first candle in the reverse trend closing far from support. See what happened was, in this case, downtrend reversal. This would have been our candle we would have bought them. But if you waited for this to close to confirm the reversal, guess what? You don't have enough profit in here to cover your risk reward and make your trade. So you've lost all of this out. So how do you enter this trade without getting burnt time and time again? This means you miss out on a lot of profit, which is obviously not good. The key to reversal trading, or any trading in that matter, is getting in at the right time. So how do you do that? Well, how do you enter the reversal trade? So I have tested countless methods in the last 15 years. In that time, I found 3 awesome traits of entering on a new high-low, retrace entries, and distance entries. When indecision forms on area support and resistance, you can use the high-low of the indecision candle as the trigger and as the stop loss. So in other words, we would place our stop loss. In this case, we're looking at an uptrending market, our indecision candle. So we would be selling into this market. We would use the high of this candle as our stop loss. We would use the low of this candle as our entry. Now, price closed somewhere in here. What we're going to do is we're going to set up a trade to enter the market at this price. So if it ends up continuing up, we never entered the trade. If it entered and continued down, we have then entered the trade in the right direction. So it's fairly easy. Now, granted, sometimes it's going to go right or wrong against you, but statistically, you will come out ahead. And that's what you need to know. You're not going to have a 100% success rate, but if you have a 66, that's 2 out of 3 trades always making you profit. Now, in trading highs and lows, it's very important. If the new low is created from resistance, it indicates sellers are taking control of the price, which means we want to be short. Okay. So last case, we were short. This case, market's coming down. Indecision candle, set our entry level, our stop loss. We would enter on this candle when it passed that price. So at this candle, at the end of this candle formation, we can set up our whole trade as a limit order so that the platform automatically triggers our trade at this price. But there's one little more thing that takes a human being to make a decision. Okay. Number one, we need to set our target because we need to be able to calculate our risk reward ratio. Targets are also very easy. You need to make sure your target comes before the next major barrier, like the next area of support or resistance in the opposite direction, as well as you have to look at any key psychological areas. Like if we saw gold and the next resistance area was at 1610, we're at 1590, we know 1600 is a key psychological area. Okay. And then you have to calculate your risk reward ratio. So stop loss, target, entry point, target point. If your target is beyond the next resistance or the key psychological distance, then you can't make it. If that's what it takes you to set your 3 to 1, can't make that trade. The last key is we want to look at volume. Volume should diminish when we get the resistance candle and should increase when we get the reversal candle. In trading, a lot of people tend to overcomplicate simple concepts. Sure, some of the concepts of trading are not the sort of things you would intuitively know, but many things are. You just have to know what to look for. So trading and using Japanese candlesticks can be very easy. This is an actual strategy without memorizing patterns and recognition. You know what you're looking for. You're looking for a small candle, strong upper wick or lower wick, and short upper wick and that side forming on a support or resistance zone after a strong trend move. Easy enough. And you have a simple 1, 2, 3 indecision trading strategy using candlesticks. So thank you very much for joining us today. I hope you learned a little bit, and we'll talk to you again later in the week. And again, if you have any questions, you can go to www.LegacyFX to get some straight answers on trading and education, or you can watch a recorded version of this class to break it all down and see it again by using the same link you used to attend this class, or wait for us to clean it up and put it on investing.com. Have a great afternoon now, and we'll talk to you again real soon. Bye now.